All right, welcome everyone to our webinar, responding to disruption. As we all notice, we are in times of crisis currently, and coronavirus has actually changed lots of things generally, but of course also on the marketing advertising side. So what we'd like to do with you guys today is actually walk you through the different topics. So first of all, we'd like to take a look at what the impact of the COVID-19 pandemic on fashion retail and online advertising is. So we take a look at some numbers across different markets, UK, US, and Germany. Then have a brief look at what potential immediate measures are to react to the current crisis and to manage it in the best possible way. And last but not least, take a rather long-term view as things are changing right now, and there's a lot of pressure on many companies. It's also a good opportunity to really change things for the better long run and get things right. And there's currently urgency. So we'd like to give you some advice on what can generally be done to drive campaigns beyond just COVID. A few words about myself. I'm actually quite a coffee nerd. You see me with my beard, which I got when I moved from Berlin to Brooklyn. And when I have time between webinars and my work, I love doing calisthenics, respectively handstand. And yeah, that's all about myself. I'm founder and CEO of Crealytics, and let's get right into the content, which is the reason why you've joined this webinar. So let's take a very, very high level view. And what you see here in this table is reflecting how many people who have previously bought offline, what percentage of these guys are now purchasing online. So basically have changed their shopping behavior and now satisfy their needs by buying products online. And it's remarkable, first of all, to see that China has by far the largest shift. And so we were wondering what are actually dynamics here. And one theory is that how heavy the lockdown actually was, so how much you were forced to buy things online and had no ability to purchase them in your in stores, that this is one factor which influences things. And China had a very drastic lockdown, so this might be one of the reasons why you see this big shift. What is really interesting to see in, for example, hygiene products, household cleaning products, and also food and drink delivery, you see a massive impact in China. So lots of people have actually changed their behavior and now buy online. And let's take a look at Germany, for example. Hygiene products, hand sanitizers, toilet paper. This is usually something you would buy in Germany in grocery stores, the same as household and cleaning products. And we see a pretty weak, small growth here in Germany, while China is massive, but also UK and the United States is more apparent here, this shift. So how do we explain this? And don't take my words for granted. It's not, I don't have full confidence, but a theory on this, why we see such a small shift in Germany. So one thing to notice is there an infrastructure actually so that people can easily buy things online? And if you take a look at the German market, there are some large cities like Berlin where it's possible to buy things online from grocery stores, but in general, it's not easy. If you live in a smaller German town, there's just no way to order things from stores. So while there might be a lot of demand, it's actually hard for people to do what they would prefer. So you see that the market in Germany is lagging behind to some extent. As we focus today on fashion, it ranks high across all countries. So in Germany, we see the second biggest shift in fashion. We have a very solid infrastructure in Germany. There are companies like Zalando and About You, so there's actually a possibility to purchase online. It's quite easy. And also in the other markets, we see that fashion saw quite an uplift. If we take a look at the UK market and the overall fashion sales compared to the previous year, we see that it's actually a pretty drastic decline of 28%, which can be explained simply by all the store closures and demand not fully shifting to online. And this is why overall we see quite a strong decline in fashion and clothing in the UK. If we take a slightly different view and take only a look at the impact of online sales, you see that it went down by roughly 18%, which isn't as severe as we saw before, the 28%. So we see that there's, of course, some shift happening. And so people who have previously bought offline now request their products online. What is interesting that in this group, textile, clothing, footwear stores, there are omni-channel companies in there, but also the majority of these in the UK, there's a heavy online penetration. And we see one major difference between omni-channel companies and online pure players. If you are omni-channel and you have a large customer base, people who have previously bought mainly in stores, many of them now have no other option than moving online and buying these products online. Online pure players don't have this effect. So we see a generally strong decline in online pure due to the crisis, while the omni-channel players see rather sometimes even an increase in online sales due or thanks to that shift towards online. So let's take a closer look at this. This is a comparison of omni-channel versus pure online in the US, and you can clearly see the difference here. So pure online actually went down substantially, while omni-channel roughly stayed stable, is even increasing towards the end. So it's something which is definitely beneficial for omni-channel players who want to make this shift to online, and they have a big opportunity right now to kind of educate their clients and change their habits so that they buy more online than just in stores. If we take a look at online pure players, the picture doesn't look that great. So you can see Amazon is actually down quite a bit. So it's 28% decline. What we see here is roughly the same numbers for ASOS sales, which seem to have declined by 25%. And also Zalando is seeing a major impact. So it's clear why this is happening, because people are locked into their apartments. They don't go out that much. So buying fashion items is mostly delayed. People wait until they can get out of their home offices again. Let's take a look at revenue development across the different markets from what we see. And just one thing you need to notice, of course, we don't have a market share reflecting the broad spectrum of all different players. So there's always a blend of omni-channel and online pure players here, which might influence the numbers a bit, but directionally that's still right. So we see that in Germany and in the UK, there's actually quite a substantial uplift in online sales from what we see. While in the US, we see that with the lockdown, which happened in Germany around about calendar week 12, in the US a little bit later, that the revenues actually in the US are most affected. And in Germany and UK, we see a substantially more positive picture. Let's zoom a little bit into these numbers, because there are lots of factors which can actually influence revenue. And it could be a change in conversion rate, could be change in demand and click volume. So let's dig a little bit into these numbers. So what you can see here is the click development over time. And we see that at the beginning, when the different store closures happened, there was a quite significant decline in the number of clicks. And then we saw them increasing again. In Germany, apparently we're at a much higher level than we were before. And you see here, UK is now roughly at the same level, and US is still down quite a bit. Very interesting, if we switch this view and take a look at the CPC development here, we see that right at the point, take a look at the previous graph again, we have this dip around about calendar week 12. So the number of clicks went down. If we now go to this other slide here and take a look at the CPC, roughly at the same time when we had this dip in number of clicks, we saw a substantial increase in CPCs, which now normalized a little bit again. So how do we explain this? I think it's a simple, we can simply explain this with a simple math, that budgets seem to be very rigid. The majority of companies out there, and these charts prove it, are working on by budgeting the next period of time instead of relying on efficiency KPIs. So would companies target a certain ROAS, a certain ROI, budgets would be fully flexible. However, they seem to not be fully flexible, and instead we see that if the demand goes down, the number of clicks goes down, a fixed budget is then allocated to a lower amount of clicks in the end, which leads exactly to this peak in cost per click we see here. So it's actually, I would say, a problem which could have been managed much better by having more flexible budgets here. And then let's take a look at the conversion rate development. Actually, in the US, this seems to be completely stable, so there is no change. It's just change on the demand side, but the conversion rate stays the same. So it seems that for the US, if people keep searching, they also tend to convert at the same rate as before. In Germany and the UK, we see even a higher conversion rate, which is really hard to explain, and I tried, but I mean, the question here is, I would have expected people now being locked in their apartments, that many more people would just browse instead of really looking for something they will buy. But the numbers suggest that this is simply not true, and we see a rather positive conversion rate development in the UK and in Germany as well. So this picture you see here is very typical. People tend to sit in front of their computers and have their screen share on. And the guy here doesn't know that you can see that he doesn't wear pants actually, which suggests that people focus on everything beyond top bottoms, and they change their behavior, because what you need right now in order to look good might be a bit different compared to normal times. This is just my intro. Let's take a look at a few numbers here. So interest sweatpants, compare 2019 versus 2020. It's a very, very heavy, strong impact. We see sweatpants going up quite a bit. So this is comfort wear, things you wear at home. And we see this, it's just one example, we see this across the board, that people now have different needs, and demand is changing accordingly. The same for dresses. Why would people now wear dresses and look for dresses if you mainly spend time at home? And you see this drastic decline in dresses. So depending on what kind of assortment a retailer carries, the impact of COVID might be completely different. And one thing we see that everything which is rather luxury and high-end seems to suffer a bit more, plus all the items you wouldn't really wear at home. Let's take a brief look at immediate measures you can actually take in order to respond to the crisis and make the best out of it, and emerge as a winner, hopefully. So the first thing I kind of mentioned already on the previous slides, it's now, as times are so volatile, it's key to success that your budgets are flexible. It's very, very hard to foresee how conversion rates and demand in general is evolving over time with all the changes we see in regards to the different lockdown measures and store closures and store openings and so on. So it's impossible to budget now for the next couple of weeks. And I would say in general, companies which tend to focus on relative KPIs and keep their budgets floating have a huge advantage, but it's even more important in these very volatile times. So if you have a process in place where you set your budgets for the next month, I'd suggest that this should be reviewed. One thing which can be done is, I mean, of course, there are certain limitations, right? You might not have enough liquidity to invest more than a specific budget. So, but what you can do, you can set a maximum budget, and which doesn't have to necessarily be depleted. In this case, you would operate until a certain point. You can scale campaigns, and if you hit the maximum budget, you have to just stop it. But in between, you are free, and you don't focus on necessarily spending it all at the expense of your efficiency KPIs. A second aspect is that strategies now overall change. So the business goals might have been before heavy new customer acquisition, very long-term focus. Now we have two limitations. We might not have enough money to invest. Omni-channel retailers have lost almost 100% of their in-store sales. So the amount of money which can be invested is just limited here. So in this case, it doesn't really make sense to focus on very long-term goals like customer lifetime value, where you win your money back in a couple of months or even years. You should rather make sure that you invest short-term. A second aspect is that you might sit on a lot of stock which has to be turned. So if you now invest your money into rather expensive new customer acquisition, it's definitely not the best mechanism for heavy stock turnover. And so I think there's just this different view right now that you have to get your products across, otherwise you will never ever sell them. And there's just no way to sell things designed for spring in fall. It's just not gonna work. So I think it's time to review how you actually approach things, what the overall business goals are, and use advertising to specifically support these goals. And this might be an entirely different approach compared to what you have taken previously. And last but not least, you have to tailor strategies to each market in which you operate. You saw the very different pictures across the market, and there is no one fits all approach. So if you are selling into 5, 10 different markets, treat them all separately and don't apply the same strategy across everything. Let's take a look at rather long-term things. As I mentioned initially, we are in a crisis right now. Lots of companies are under pressure, and when there's no pressure, there's also no need to actually make drastic changes. I think let's see this as an opportunity right now and challenge the status quo and rethink how you're going to approach things going forward once the crisis is over, hopefully soon. So most businesses, and I'm sure that many of the current attendees know this as well, what you're usually being asked to accomplish is drive some more revenue. And if you do everything and with all the tricks and tactical measures, you might be able to squeeze out a little bit. But if you really think about what your company needs beyond the targets you just received from someone, it's actually a quite different thing. You want to sell high margin products, ideally the ones which have lower return rates. And instead of always selling these products to existing customers, you want to drive new customer acquisition. And in this sense, focusing on revenue isn't the ideal approach, because if you do this, you end up getting the cheapest revenue, which tends to be getting low margin products across, which have high return rates. So it means low competition and selling all this stuff to existing customers, because it's much harder and more expensive to find new customers. But if you approach it this way, you will end up with great top line KPIs, but bottom line things won't pay off. So how can we change this going forward? And the trick here, or the way to handle this, is actually, first of all, changing the target. It should not be just top line revenue, but you somehow have to factor in new customer acquisition, return rates, and margins. And you need to put these numbers back into any biddable media system, whether this is TROAS on the Google side or whether it's Facebook, it doesn't matter. You have to find a way to inform AI what your business is about and what your actual targets are. And again, it's in probably very, very rare cases, it's actually revenue, although you might see that you constantly have discussions about driving revenue in paid search. I doubt that this is the true target. So let's take a look what actually happens if you pivot from a revenue focus more towards a customer lifetime value focus with data activation. And we actually did this. So we see some numbers here on the difference of TROAS absorbing just top line revenue figures versus a TROAS which receives customer lifetime value information, which is essentially you measure the margin of the first purchase from newly acquired customers, and you also reflect that there's more value, that there's a certain customer lifetime value. So you expect people who buy once to come back, and you need to inform biddable media that there's more than just this first purchase on which we constantly focus. Because if we take a long-term view, it doesn't help really if we get products across to people who buy once and never come back. We'd like to sell to the guys who buy once and constantly come back and repurchase to the segments where there's a high customer lifetime value. If you communicate back revenue to the system, it will drive revenue, but not the long-term KPIs. So what happens if you put the right metrics back into TROAS for what it's actually not designed, but it can absorb any number you want it to optimize against? So once we put back customer lifetime value KPIs into the bidding, we saw that new customer acquisition actually increased by 113%. So how do we explain this? Simply, the system will learn over time where it acquires existing customers, where it acquires new customers. And in the area where we mainly drive new customer acquisition, Google will see a much higher value. So they will, the algorithm will automatically take budget from where we previously sold to existing customers and will reallocate it where we drive more value, hence where we acquire new customers which have more value than just their first purchase. At the same time, you see that the customer acquisition costs decrease by 50%. And if you take this long-term view, like margins coming in not only for the first purchase, but also all the repeats coming in and their margins, you see that the long-term ROI goes up substantially. So you can immediately see that this is a really heavy impact you have by using the exactly same underlying algorithm. So it's all TROAS, but informing it with different KPIs and helping it to actually work against your specific targets instead of just plain revenue optimization. If we take a look at this chart here and we just compare existing customers versus new customers, so you see in the bluish segment, the new customers before with TROAS just out of the box, and on the right here with data activation, you can immediately see what increased heavily here. So it's definitely existing customers go down substantially while new customer acquisition goes up, and the biggest increase we saw in generics from 38% to 58%. So just underlying what the first slide or the previous slide actually said. So this is something which definitely works incredibly well, and it changes the way we run search from in past times, a highly tactical approach, managing your keywords, managing creatives, and just driving some KPI towards actually focusing on the measurement side, taking CLV and margins into account and putting these figures back into the system to create something which is, I would say, self-sustaining, a system which reacts to shifts in demand, to changes in margin structures without us having to overlay rules, which would mean that in campaign segment A, we target a ROAS of 4 because we tend to acquire mostly existing customers, and we are happy with a lower ROAS of only 3 in a different segment because we sell to mostly existing customers. Such a setup where you implement lots of different rules and you translate it into ROAS is quite difficult to maintain, and it requires a lot of knowledge. It's not a sustainable system which works for you. It's high maintenance, and it depends a lot on the skill set of people sitting in front of these campaigns. So it's definitely the harder approach to maintain, while the other approach, data activation, requires much more thought and input initially, but once you've implemented this, you created this system which is going to work on your behalf for the next couple of years. So moving one level down, how does this actually work? So how can we make all this happen? First of all, just take a look at where are we today. Usually it's a revenue optimization. What you can do, you can go one step further and focus on a profit or ROI, which means you have to take your margins of the orders into account. What you can then do as a next level, you can say, okay, on average, a new customer has a value of X, and I start incorporating this average new customer value and work on a customer lifetime value ROI. And then we already get into a world where we can predict right away when new customers purchase how valuable they will be over time. At least we can directionally define this or measure this already. So in this world with predictive CLV ROI, you have the most granular structure in place where you inform the bidding on a very granular level, not only that there's a new customer which has a certain value, but also that between these new customers there are differences, and some of them are more valuable and others are less valuable. So let's take a look at how this actually works and how you can implement such a system. So I walk you once through this optimization cycle now and give you also some details. So the first step is you need to track your customer journey, because you need it later on for attribution. At some point, people then end their journey and they purchase. When at the point of time when the purchase happens, this is where you need to put back the right numbers on a per click level into Google's AI or Facebook's AI or whatsoever biddable media system is operating. So you need to assess the margins of your first order. You have to take into account returns as they come in over time. And you also have to give specific clicks a certain fair share of their of the overall conversion value based on the customer journey, incrementality, and attribution. And these values you put back into the system instead of just plain revenue information. And once the system contains this data, it will just operate as usual. It doesn't make a difference whether you put revenue numbers back or anything else. It's just a monetary value, which will, of course, then go up and down in certain areas, and you help the system to actually react on this. Once you have done this, you will see your clean numbers in the reports. And there's one limitation as of today, which can be fixed, which is what happens just beyond the first purchase. So far, we've always optimized our campaigns with a visibility into just the first purchase profitability. Now you might acquire a new customer and you put the expected long-term value into the system. So you would want to see, are people actually buying again? Do they come back? And do my assumptions actually hold true? Or am I just inflating my ad spend by putting a customer lifetime value in, but people actually don't come back? So if you take this long-term approach, it's really important that you also validate your assumptions and that you have a view which includes the repeat purchases. And there are ways to actually do this. And towards the end of the cycle, you can then see, are my predictions right? Do I need to change my models? Is my attribution working properly? Or do I see completely different results when I test for incrementality? And this is how you close the cycle and you get started again. So let's highlight a few points here, which are probably a bit, which require some explanation. The first one is just for the sake of explaining. People go through the journey, they have several clicks, and then they purchase. Let's take a look at what happens exactly at the point of time when they purchase. So the way this works is that you don't put a plain customer lifetime value back into the system. Why? Because you already have more information at hand, which you can already use. So means an average value for a new customer might be $50, but the first order, if someone has purchased for 1,000, you know that this value will be greater. For this reason, we take the initial purchase already, we measure the margin, and we then add a residual lifetime value on top of this to reflect that there's more than just this first purchase. And based on your attribution system, then this overall value gets sliced and will be assigned to individual clicks of the customer journey. And once we have done all this, we have the most accurate estimated value on a per click level, which is precisely what biddable media systems need for their decision making. And there are ways to ingest this information into the Google bidding, for example. And what we do here is a two-steps process. usually you do not have all the information at hand, especially attribution. You won't get it in real time. Customer lifetime value is hard because you might have to find out whether it was actually a new customer or not, which isn't always available right away when the purchase happened. So what we do is we put some estimated value back into the system, and then we wait until we get more information. So returns come in, we know it was a new customer, we can calculate the new customer value, we see what came out of the attribution, and then at that point we can overwrite the value the Google system contained and help it to make better decisions going forward. Even if there's a delay of 1 day, decisions never happen just now in real time, taking real time information into account. Each biddable media system will still go way back into history, take information, extrapolate it, and make decisions accordingly. So once we have this value per click, we put it back into the system. And then is the point where we can actually start generating insights. And this is just an example of a dashboard we have built. So we basically pull data into a data lake and we then show insights. It's potentially something you can also build. There are lots of retailers out there building their own data infrastructure. So this is something, if you find it interesting, you can also try to implement. What do we see here? So the difference, the major difference is that we have this view beyond just the first purchase. So let's go through this chart here. You see an ad spend, then you can see the order margin, so not revenue, from selling to just existing customers. Then in the third column, the 14.9 million is the margin you sold to new customers and their first purchase. And now the difference starts coming in because these new customers will make repeat purchases over time. So as you can see here, it's just a time range we selected. So within the time range, already the first repeats might have happened. So we add them on top here. And then there's of course something which is still outstanding because there are people who have purchased towards the end of the time frame and they haven't had the opportunity to make all the repeat purchases. So there's more we would predict over time, and we split it into two parts here, which is how much do we expect that we need to retain these guys, but also how much margin we actually expect to come in over time. And then you actually can see what your overall profitability of a longer term time frame was. And this picture might be entirely different. So if you just, if you start implementing a customer lifetime value centric approach, there will be lots of questions coming from finance as well. And most people will be cautious because we are betting on sales which happen at some point in the future. So showing these insights will give people way more confidence and will help a lot to make this really necessary pivot, which some companies like Amazon have done ages before because it's just very effective. So once you are at the end, then you need to review whether your assumptions hold true. And it might be that we overestimated the customer lifetime value. It could also be that the attribution didn't match what we saw in incrementality tests. So instead of now going into the system and making layering rules on top of it, we should rather take a look at the models and be better in predicting the customer lifetime value, choose a better attribution model and refine the whole thing, but always for the sake of having a sustainable system which works for us instead of just interfering all the time and having really high maintenance costs, time delays, and so on.